Welcome to the Long-Term Investor. Today with me is David Braun, who has been with PIMCO for 13 years and is a U.S. generalist fixed income portfolio manager in their New York office. He has 28 years of investment and risk management experience along with some actuarial experience, and I can't think of anybody better than David to help walk us through some of what's going on in the bond market. David, thanks so much for joining me
Peter,
today.
thank you very much for having me. The privilege is all mine.
Well, a lot of clients are opening up their year-end statements, and interest rates changed quite a bit over the last 6 months of 2021, and even 1 month into 2022. When we're recording this right now, we're about midway through February, and ultimately, people are seeing losses in their bond portfolio. And this is an area of a portfolio where people are thinking there's supposed to be some safety. Bond losses are normal, but I was hoping, David, that you could start us out with a little bit of background on what has been going on in the bond market overall.
Yeah, great question, Peter. So nobody likes losses, but let me walk you through what's going on. So our outlook for the markets is it's called investing in a fast-moving cycle. And what we mean by that is if you think about the COVID recession, it was one of the sharpest, most violent in history. Whether you look at GDP drawdown, the unemployment rate, how fast it rose, stock market drawdown, that condensed period of time was one of the fastest, most violent recessions we ever saw. But we've quickly moved from an early cycle recovery to a mid-cycle recovery. Now we're well into a late cycle recovery. So rising rates in the late part of a recovery is very consistent. The Fed has said they're starting to see inflation numbers that they no longer believe are transitory. So they're starting to explain to the market how they're going to be tightening policy and removing that accommodation, both with hiking rates and with doing quantitative tightening, which is letting the balance sheet run off. And the bond market, the front end of the yield curve in particular, has repriced itself for that path of Fed tightening. Now, we think the bulk of it is largely behind us. What I mean by that is if you go back to August 2020, the 10-year Treasury closed at 51 basis points, something I never thought I'd see in my career. And now we're at about 180, 190. So the bulk of that rate move, that 130, 140 basis points is behind us. We think rates are approaching a level that are consistent with fair value. So the pain is behind us. And the beautiful thing about bonds is when you take that initial pain of rates rising and your NAVs going down in your funds, that's not fun. Nobody likes that. However, the nice thing is you now have a much higher forward-looking yield. So you can essentially punch your way out of it just by the forward momentum of your higher yield. And at the end of the day, rising rates, as long as they don't rise too much, and like I said, we think we're largely done with the rate rise, and they don't rise too violently, you can usually grind out a positive return after that because of that higher yield. So like for instance, the Barclays Corporate Ag is now yielding north of 2%, around 210 as of the time of this recording. And any active manager who is doing the job right is probably getting you about 100 basis points higher than that. So you're all of a sudden looking at a 3% yield now on an actively managed core bond fund, to offset those losses that are in the rearview mirror.
Well, and David, it's funny that you mentioned the cycle. It's a great example of how there are no two economic cycles that are the same. And people do often feel a bit of consternation when rates are going up. And I love that you suggest there that long-term investors, particularly if your time horizon is longer than the duration of your portfolio, might actually end up benefiting from some of these interest rate increases. And some of the interest rates, maybe you could dig into a little bit more of the why behind interest rates increasing, both a little bit this year and maybe what you think is happening last year.
Yeah, so I think it's the market waking up to the fact that not just the Fed, but now the ECB came out with some hawkish comments recently. And so you've got the major central bankers acknowledging that inflation has been more durable, not going down without a fight, and less transitory than they had originally hypothesized. And labor market growth, you just saw the labor market numbers for January, giving them the air cover that, hey, inflation's running high. We seem like we're at or close to full employment. Let's get off of zero, right? Zero Fed funds rate is an emergency policy rate. An $8.7 trillion balance sheet that we're still growing is an emergency tactic to get us out of that recession. Now that we're largely at, I didn't really hit this before, but like the faster we fell, it was very scary how fast we fell. But look at the snapback. And yeah, we can all say, well, a lot of that snapback was fiscal spending and monetary accommodation, but the snapback is quite powerful. we're essentially, what are we, less than 2 years away, 18 months from the end of the recession, and we're pretty much back at full employment. GDP, if you took 2019's GDP and grew it with our trend line here in the U.S., we're pretty much back there. And the S&P 500, yes, having softness and start 2022, but last year in 2021, it established new highs 70 times. So by those three metrics, GDP, labor markets, risk assets, it's as if the recession never happened. So therefore, it's logical that the Fed removes the accommodation and we get back to more normal rates. Our view is, Fed funds will hike to around 2.25. Remember last time in 2018, we got to 2.5 and it stalled the economy and it choked off risk appetites in the risk markets. And we would argue back then things were pretty good, right? We were about to set a record expansion in the United States. We were at 3.5% unemployment. We were running $1 trillion fiscal deficit. And the economy couldn't handle it, and risk assets couldn't handle 2.5 Fed funds. So if you look at most recessions, when you come out of it, the terminal rate of Fed funds is usually lower than the prior one. So we think around a 2.25, and that all ties into what I said before about the bulk of the rate move up is priced in. If that's all the Fed could get to, and you think about where the 10-year was before any of us knew what coronavirus was, it was around 180, and we're a little bit above that now. So yeah, we may overshoot, but we're not far off from fair value and where we think rates settle out.
And David, obviously PIMCO is a household name in my opinion for bond investing. And when people talk about the Fed raising rates, a lot of the public doesn't realize, well, they just raised the overnight rate. They would love to control the entire yield curve, but it's more like walking a dog. If they're holding the leash of the dog and they're letting the dog wind all over the place, they can tug on it and try to tighten that leash. And that is a little of what's happening. But in your role, investing funds on behalf of both retail and institutional clients, you obviously know this, but as you say, it's priced in. Those higher interest rates are already priced in. Then maybe you could share a little of your outlook for interest rates across the curve for some of our listeners.
Yeah, so at the end of the day, the front end is pricing a path that we think is commensurate with what the Fed will do. Perhaps you could argue that the longer end should be a little higher and there should be more term premium, right? Because we're entering a highly uncertain path, right? People ask what our highest conviction view is. I would say one of our highest conviction views is uncertainty and volatility that we're seeing in the first 5-6 weeks of 2022 is likely here to stay, right? We are asking the economy to take a major handoff from a fiscal and monetary-led recovery to an aggregate demand out of households and corporate America spending their money to kind of take the baton from fiscal and monetary, right? That's kind of like tectonic plate shifting. And we're going from all-time biggest ever quantitative easing balance sheet growth we've ever seen, not just in the U.S., but everywhere, to eventual quantitative tightening. So we would argue when you've got a highly uncertain environment like that, you should get some, and then not to mention, that this is probably a big piece, is inflation, have we entered a new regime in inflation? Or are we eventually going to burn down to something more Fed-like? Our base case is, core CPI probably peaks in the next month or two, and then by year end pulls down to below 3, still an elevated number, but, getting closer to the Fed's, target on PCE, which, should be 30, 40 basis points lower than core CPI. And then in 2023, we're back to Fed-like levels of inflation. So we don't think we've, on our base case, entered a new regime of structurally higher inflation, but that is certainly a risk, right? Let's talk about the risk to the right and the left of inflation. That can impact the shape of the yield curve. That's why I'm going on this topic. To the right of inflation, if we're wrong and inflation is, structurally entered a higher regime, it would be drivers like all the fiscal and monetary stimulus we did. As it gets put out in the economy, eventually the velocity of that money churns and burns and you get higher inflation. Second is, everywhere you look, you see everyone trying to de-globalize their supply chains, right? Pull them back home because we saw how precarious our ability to produce goods was when our supply chains are around the globe and we're running just-in-time inventory management. That is inflationary because you're pulling jobs and production to higher cost parts of the globe. And then the third thing is this brown to green energy movement we have. It could be inflationary on a durable basis as you're, pulling more of the goods that you need for other things, think semiconductors, copper wire, et cetera, to produce that green energy source. That could be structurally higher inflation. But to the left, there's other things, right? Think about this, the productivity gains we're making, right? We just spent a whole bunch of CapEx on technology to get our workers to be able to do more with less, during the COVID lockdowns when we're working from home, et cetera. There's also been the digitalization of how we consume as a society. That is all disinflationary as it leads to higher productivity and should have disinflationary pressures. Another element that we would say that could be disinflationary is the high debt stock we have, right? So we all know banks and households have delevered their balance sheet, but the federal government and non-financial corporates have added leverage over the past decade or so. And therefore, as an economy, we are higher leveraged than we were before. And then the third thing is, look, right now we're seeing wage inflation as the economy is kind of in flux. So, we saw how many 3-4 million people left the labor force during COVID. There's a scarcity of getting people to fill some of these service jobs. So there is inflation in the wages. But at the end of the day, when we think we get past this, rejiggering and reshifting of the labor market and the jobs, that we'll get back to the prior years. And remember, we had an 11-year record expansion, and we had an incredibly flat Phillips curve, which shows unemployment versus inflation. Normally when unemployment gets low, inflation rises. That didn't happen last time. So those are three things to think about to the left and three things to think about to the right.
That's absolutely great stuff, David. And there was something in there as you were going into that explanation where you said, particularly with the rate outlook, that uncertainty and volatility are here to stay. And with starting yields so low, mistakes are more costly, in my opinion. I also, as an allocator myself, so PlanCorp, as of year end, is managing a little over $6 billion for clients. And we know that these uncertainties exist. The world is always uncertain. But in the bond space particularly, the case for a core bond holding is really becoming important, especially as the universe has changed over the years with all this uncertainty, giving the manager some flexibility, as well as, again, trying to avoid mistakes. If you are not going to earn that much to begin with, those mistakes really can wipe out your return quickly. I was hoping, again, kind of from your viewpoint in your role at PIMCO, how you think about the case for a core bond holding within broader portfolio construction.
Yeah, so you're absolutely right, Peter. Earlier points in my career when the outlook was very uncertain, as an investor, you had perhaps some more cushion and safety margin in spreads and risk assets. But if you look at where things are priced, we break things up into quartiles for the last 20 years, and PE ratios are firmly in 90th percentile type rich levels on that measurement. Investment grade corporate spreads and high yield corporate spreads are firmly in that fourth quartile as far as richness. So the risk assets, at least generically, that a bondholder has at their disposal, investment grade bonds, high yield bonds, agency mortgages, are almost priced to perfection, and not acknowledging that uncertainty. Right? When you have a lot of uncertainty, you as an investor to deploy your capital, or in mine and yours cases, our clients' capital, should be getting a higher safety margin, because uncertainty and volatility means I need to get paid more to take risk. That's not happening right now. So our view of core bonds is, and I'm sure we'll get to specifics of what we're investing in, but just in general, look, you want to own core bonds when the outlook's uncertain, right? Because what do core bonds do? They provide you income, first and foremost, right? And yes, the income isn't what it was earlier in my career, but like I just mentioned, the ag's back to 2% yield, and a lot of active funds, a lot of active managers who are benchmarked to the ag are about 3% yield to worst right now. So you're talking to 2 to 3, or maybe some cap appreciation and some alpha. Not bad. What I would say there is, question which part of the equation isn't working there. We all know why bonds fell in January. We just talked about that. That's how you started the call. Fed's in motion. Other central banks are signaling a hiking cycle. Thus, bonds are going to fall in price. To me, the bigger question and concern, quite frankly, is why are stocks falling? Our growth is good. Job numbers are good. Stocks are falling potentially because that stimulus, that cheap money and monetary supply, was causing elevated valuations. I would argue now that the pain of bonds falling, that illumination of the fragility of potentially of stock values, given, we're talking modest tightening, 200 basis points of rate hikes by the Fed, and the stock market's falling and having trouble finding its own footing. So that to me, I'm a bond guy, so maybe I'm talking my own book, but that to me signals another reason why you need bonds. Perhaps these valuations are a little elevated.
Well, David, you and I are on the same page on a lot of things there, particularly because bonds are supposed to be helping reduce the overall volatility of the portfolio. And you raise a good point about stocks. For listeners, when you think about past stock returns, they're typically made up of earnings growth, cash return to shareholders, and changes in valuation. And I think when we look back at these losses, what we're going to see is that there's been a lot of changes in valuation, and it's psychological. There is some calculus involved, and it's an ever-changing mix. But certainly that does, you look at the different pieces of your portfolio, see if they're playing their role together. And one more thing I want to comment on that you'd mentioned with the 60-40, David, is I think the idea that everybody should have a 60-40 is very dead. But just because something's going to have a lower return, a lower expected return over the next 10 years, doesn't mean it's broken. I think people forget that averages are supposed to spend time above the average and below the average. So if the next 10 years are below average returns, so be it. And I think the case that you and I are both making for core bonds within a broader portfolio is really important. Unlike the equity side, where perhaps people think of indexing as the core piece, I do think that a lot of people don't understand why indexing in bonds is a lot different than indexing in stocks. Maybe you could share a few thoughts on that.
Yeah, so look, at PIMCO, we firmly believe that the prudent, attractive way to run bonds is active, right? That's what we were founded on 50 years ago. PIMCO basically was a pioneer who invented active management of bonds. And right now, there is a massive proliferation of passive strategies out there delivering what we feel is an inferior strategy to investors. So let's think about this. So the flaws, and go to our website if you're interested and read our research. It's under the header, bonds are different. So we did research, not just...
And David, I'll link to that in the longterminvestor.com. Anyone watching can go to the show notes and We'll make sure to link to that.
So there we did, our quantitative team did an analysis, not just of PIMCO's funds, but the whole industry, ETFs and mutual funds, and showed that while in large cap equity space, as you mentioned, active managers have had a tough time beating their passive benchmarks and their passive peers. Active bond managers, especially in the core bond space, have indeed been successful over history beating their passive peer groups. Okay, so that's our data. Go check it out. A couple of reasons why we think bonds are different, and we talk about this in there, but I'll just hit with some of them. One, think about stocks. They're exchange traded, right? And incredible transparency, high liquidity, tight transaction costs. The bulk of the bond market is still over-the-counter traded, where an active manager can hopefully garner an execution edge, an information edge, and exploit some of those inefficiencies that an OTC market has. Second, the number of securities. Think about the S&P 500. It's 500 securities, no surprise. The Barclays Corporate Ag, which is the bellwether corporate core bond index in the U.S. So the Barclays Ag, not the Corporate Ag, has 12,000 securities in it, right? And think about a common stock. There's one share of a common stock for those 500 companies. Those 500 companies, if they're represented in the Ag, they may have dozens of different CUSIPs given the bonds they've issued throughout the years. So it's not as easy of a game to replicate, and there's inefficiencies, there's attractive points, there's unattractive points, etc. And then turnover. The S&P turns over about 4% a year, so I get why you might be able to replicate it with low friction costs. The S&P, the Barclays U.S. Ag turns over 40% a year. So you're chasing something that has a lot of inherent turnover, and it's a less liquid market, more opaque market. And then finally, just more philosophical things we don't like about indexing. Well, if you index your corporate bonds or even the corporates that are in the Ag, you're by definition, it's debt cap weighted. So what that means is you lend more and more of your money to the most indebted issuers. The serial issuers who borrow a lot of money, you blindly lend to them. I'm a simple person who thinks of analogies. Think if you and I pooled our money together and we launched a bank there in St. Louis where you are, the Dave and Peter Bank. And our underwriting manual was this. When someone comes in and asks us for a loan, all we ask them is how much debt you have outstanding already. And if they say a lot, we give them a big loan. If they say none, we say, you're not for me, go to another bank. It's kind of the reverse of the way my brain works on how you should be lending your money. Second is there's a tremendous halo effect on a bond when it's anointed index eligible, right? So rating agencies rate it index eligible, it's issued big enough size, and they have a captive buyer base. Thus, they can finance at a lower spread. So kind of all the juice is squeezed out potentially because everyone's trampling over themselves to buy it. The passive managers, the lower active share managers than at PIMCO. We try to go outside of index eligible bonds where there's less buyer demand and we can cultivate better risk-adjusted returns for our clients. And then this one's another painful one. Nobody wants to buy high and sell low in investments. And when you sign up to invest in an index, you're in essence signing up to do that. What I mean by that is as soon as it's anointed no longer index eligible. So let's say a triple B corporate falls to double B, it's going to drop 10 plus points in price typically. And then you are going to be forced to sell it at the worst possible time because it's out of your index, and indexing is paint by numbers. Similarly, when it comes back, so a falling angel, it comes back to a rising star, you wait for it to enter the index, and then you buy it again at a high price. So you're buying high, selling low mechanistically. Not the right way to run money. So that's what I would say. And I'm sure we're going to get to it, but there's a lot of things an active manager can do to build a better risk-adjusted return portfolio profile.
Sure. Well, we can dive into some of that because I think for listeners who are more new to some of these bond conversations, when it pays, you had mentioned earlier, David, margin of safety and volatility and expectations. And when credit spreads are wide, what we're saying is that you are getting paid more for taking on credit risk. Or when the yield curve is steep, what we're saying is that it pays more to own a longer term bond than it does a short term bond, which is generally the dynamic, but relative to what it normally is something that a lot of managers are looking at. And all active bond management is different, lots of different flavors. But David, maybe you could talk a little bit about that, as well as, would love to hear where PIMCO sees some opportunities in the core fixed income markets these days.
Yeah, so you got to be careful. All active funds are not created equal, right? And, the passive folks will, pick on the active player and say, well, all you do is add credit beta, and then you call yourself active, but you're just adding a whole bunch of extra credit risk. And there are certainly active funds that is their strategy. And you got to be really careful. Remember I talked about bonds doing their job in March and April of last year? Well, if you had an active bond fund that just had too much credit beta in it, credit beta quickly converges to equity beta when the stock market's selling off, meaning stocks are falling, credit spreads are widening, and if you put so much credit beta in your active portfolio, it can negate the rallying in interest rates and the rising in treasury bond prices because you're losing that all and your corporate's widening because you've got too much credit. So be careful. Not all active funds are created similarly. What we try to do at PIMCO is not just throw in a bunch of credit beta. Now, certainly, like in a year like 2016 and 17, we thought credit beta was attractive, so we would add a whole bunch. But right now, as I mentioned, credit beta is firmly priced in fourth quarter for richness over the last 20 years, so not looking to add a bunch of credit beta right now. What we're trying to do is add credit alpha stories or get the same credit spread on something that has a much more resilient downside profile. So, and in order to do that, you've got to track traffic out of the generic securities because they're generic, they're overvalued because there's a captive buyer base, and they're allowed to add leverage on their balance sheet because someone's going to buy their debt because it's still in the index. Think about that. So what we're doing is we're building more diversified portfolios where we don't feel like we need to be a slave to the index and try to mirror it or cover tracking error versus it. So think about things. What do we like? We like housing. Look at the strength of household balance sheets. Households who own a home, you could argue their strength of their balance sheet has never been this stronger in decades. And we know about the housing price appreciation we've seen. Now, while we expect it to abate from the last 2 years, we still think the fundamentals of housing are quite strong because for the decade plus after the great financial crisis, we built as a nation fewer houses than were warranted by new household formation. So you've got a stock of supply and demand that's a challenge. So, a lot of our active funds in core bond space will have 10% in non-agency mortgages that we think we're getting a very attractive risk-adjusted returns commensurate with high-yield type spreads. And these securities in our mind are firmly investment grade. Second thing is we really prefer banks over non-banks. So when you look at our corporate positioning, you may say, oh, that looks kind of benchmark-like. Maybe it's the same percentage as a benchmark. But the devil's in the detail. We're very overweight banks and very underweight non-banks. Why? Because think about the last 12, 13 years since the great financial crisis. Banks have been forced by Volcker Rule Dodd-Frank to hold more capital, hold more liquidity, and take less risk. That's who I want to lend to, right? Someone with a lot of capital, a lot of liquidity, and not a lot of risk in their underlying model. Meanwhile, the non-financial world has had a debt frenzy, if you will, where they've been issuing more and more debt to appease the shareholder, buy back stock, special dividends, M&A. And when you look at the Barclays Corporate Index, that's why 13 years ago it was about a third triple Bs, and now it's over 50% triple Bs. So they've gone from single A to triple B, not because the rating agencies say, hey, I've got a new way of measuring you. It's because they've added more debt to appease the activist shareholder at the detriment of the bondholder because so much money is chasing their bonds that they can get away with it. So overweight financials, underweight non-financials. And then further things outside of benchmarks, like taxable munis are a very attractive corporate surrogate, where a lot of investors are, oh, I want credit risk, let me add corporates. Well, municipal balance sheets look very strong right now, and the taxable market is less trampled over, if you will, because there's a lot less indexers chasing it, and it often adds pretty attractive value. And then a few things like explicit COVID service reopening themes. So a little bit of aircraft, a little bit of gaming, a little bit of hospitality and leisure. Size very modestly, but at least you get a safety margin there where the prices are lower, you've got room for error, and the spreads are wider.
That's fascinating, David. And it's so interesting to hear somebody talk about that stuff who is in the thick of it. Because if you're an individual on your own, I cannot say more passionately enough, buying individual bonds one off, you just don't end up that diversified. There's a lot of cash drag. It ends up being quite costly in the spread that you end up paying for bonds. And having someone who's in the thick of it is always going to be able to be doing all that work for you. Just like I talk about being a financial advisor, doing all the work for our clients. And I know we've been focused on the core space, David, but I was hoping I could ask you about two other kind of hot topics among the people I speak with. The first is tips. So a lot of people want to hedge inflation today, which I'd be curious what you would think, but to me is a lot like buying home insurance once your roof is already on fire. The big inflation event happened. Tips pay you for unexpected inflation. And you talked about that right side and left side inflation outlook. If there's 7% inflation for the next decades, sure, tips are going to be great. CPI swaps, if you can find an option that incorporates those, maybe those are useful. But when you hear people say they want to hedge inflation, how close is that analogy to saying, hey, it's insurance when the house is already on fire?
Yeah, so I get your point. If you look at 5-year tips break evens, what are they, 280, 200? So that's assuming 5-year inflation will be 2.8%. We're relatively neutral on tips. We certainly get and appreciate the fact that for whatever reason, an investor may feel they need some inflation protection in their portfolio, and we have a lot of products, as do other investment managers,
Sure.
to help them hedge that. Overall, we feel relatively neutral on current tips valuations. It would have been a great trade if you got into it 18 months ago. Right now,
Sure.
feels pretty fairly valued. But who are we to tell somebody, hey, you don't need further inflation protection? So there are products for that. I always view my job's a lot easier than yours. I have to just focus on core bonds. Right? You have to focus on someone's whole balance sheet. So I don't profess to knowing your world. But what I'll say is tie your question back to my world. I don't feel a core bond fund should be someone's inflation protection, right? And there's a lot of ways to position a core bond for a reflationary environment. And that's certainly what we did in the funds I run and the core bonds PIMCO runs across the board. So if you go back a couple of years ago, we were like, when COVID hit and, we're looking pretty miserable, we wanted to position for reflation. And the way you position for reflation, and what I mean by that is the economy is going to grow eventually. We're not going to be here forever. The labor market's going to come back. Asset prices are going to go up, et cetera. So we wanted to be in that trade. And as a bond manager, there's maybe 4 ways you can do that. You can underweight overall duration, so underweight your treasuries and how much duration you have. And we did that in spades, and that's a nice liquid way of expressing that trade, more liquid than the tips trade. Second, you're being curve steepener, meaning that the curve should steepen as we recover and growth comes in. So we're in that trade as well. Third is overweight credit risk. And we were really overweight credit risk because it was in 2020. And the thinking there is if the economy reflates, labor markets reflate, credit spreads will come in and you'll make capital appreciation. It worked. And then the fourth leg is to throw tips in your portfolio. I was once a risk manager. It's a zero-sum game. However you weight any of those 4, you have to reduce or add to the other ones because they're all, in essence, betting on the same thing. So a lot of our core accounts had the first 3 in there quite aggressively, and then had the 4th one more modestly scaled. But obviously, if we had scaled it more aggressively, would have had to pull back from the other ones. So that's how I think about it.
Well, that's helpful. And I probably should have clarified, I have no problem with inflation protection, but I think your comment that it is fully valued is perhaps the one where if you're adding it for the first time as if now you need to protect for inflation as if you didn't prior, maybe that's a better way to frame it. So I appreciate that. Last question for you is, what does it mean to you to be a long-term investor?
Yeah, so look at PIMCO. I found my home. I've been here 13 years, and this place has a religious commitment to getting the long term right. So, our true north is our 3 to 5 year outlook. We call it the secular outlook, and that guides how we're going to invest. And I think we also study a lot of behavioral finance here. And what I love about it is, you know, just think of the last 4 or 5 weeks, right, to start 2022. If you didn't have some sort of beacon that you're kind of anchoring yourself to, I mean, you could get caught up in the euphoria of when trades are going your way and the market's validating your positions. You get caught up in the panic when the market's saying you're dead wrong in your positions and it's going against you. And we're just humans. We're flawed like that, right? We get too emotional and married to our commitments, our positions. So you got to have that kind of longer term view that keeps pulling you back to it and saying, no, this is what we believe. Now you can't be so stubborn that if the market and the economic data is saying you're dead wrong, you have to reposition and repivot. But at least there's a hurdle there to have you pause and say, this is what I thought I believed in. Now let me figure out what's noise and what's a true trend. And look, why do we do that? Because we feel a heck of a lot better about our ability to identify long-term trends than we do short-term data, short-term market moves, the short-term behavior of other investors. Like that's really hard to do. And I would question anyone who thinks they have an edge on that type of trading philosophy. And then obviously when you're a long-term investor, you got to survive for the long term. So, and we saw this in March and April of last year. A lot of these blow-ups in history, the ones who get stopped out and carried out on a stretcher are the ones who don't manage their liquidity properly, right? They have too much leverage or just too illiquid positions, and then you get the proverbial margin call. And even if your trades are right in the long run, you don't get to realize that because you're stopped out. So get your liquidity right and try to avoid over trading because of the noise.
David, I love it. Thank you so much again for joining me. And I'm going to put some information so people can find your bio on the show notes at thelongterminvestor.com. And if anyone is watching us on YouTube, be sure to like and subscribe. Drop a comment. Where do you think the bonds market where do you think the bond market's going? Let us know in the comments. Subscribe to us anywhere that you are listening to podcasts. I appreciate all the feedback that everybody continues to send in. So thank you so much. David, again, a true pleasure. Thanks for being with me.
Peter and Plan Corp, thank you for having me. This was a lot of fun.